Well, okay, but you've diagnosed what's going on, but what's the prescription? Because we want to make sure if we're exposed for a market rally, is the answer simply check your exposure? Because if you're buying those broad indices, it could be you're much more dependent on those large
Well,
companies than what you think.
that number one. And number two, if you've raced to cash because they're paying 5% in the money market fund now, get ready for that to collapse back down. And I really hope we don't end up with 0% interest rates, but don't be surprised if that happens if we have a calamity economically. So, but the 5% money market fund is probably now a thing of the past for a while. Is inflation forever and always dead? No, because it never has been. It wasn't in this period of quote unquote disinflation we had for 3 decades or so. Inflation at 2% is still a problem. We would prefer inflation to be zero. That's not the world we live in. We live in a fiat world. We live in a central banking world. That if that's the case, we're going to have inflation. It's going to be more subdued. Move back towards the trend of 2%. Sadly, that's also the trend that we have in the economy. It's a 2% economy instead of a 3% economy, and that's because of the poor policy and the poor, overall, landscape for economic growth is not as favorable as it was, say, for example, throughout the 80s and 90s. That's the 1980s and 90s.
So are you suggesting basically, it seems to be what you're saying, if I know you the way I think you are, is that small cap stocks have more room to grow, and these large income not these are
for large cap, but smaller companies that are not the most gigantic of the gigantic. If you stripped out those 7, the market really hasn't done very well in the last 2 years. I mean, it did poor. It was, I think the S&P was down, I don't know, like 18% or 20% in 2022. But then this year, we're back up over 20% on the index. But that's largely driven by the biggest of those companies. If you look deeper down into the index, they haven't done as well. A good way of seeing this is there is out there, and I don't know have the exact number, but I'd bet a lot that I'm right on this. I'm sure this is the case. The equal weighted S&P 500 has done has done poorly probably compared to the market cap weighted. I think that's for sure. I'll have to look now. I should have looked before we got on this, but.
Well, it would stand to reason because we know that the Magnificent Seven form a large part of the gains.
Yes, 30.
Of the S&P. So, and I will say this: if you take a look at the charts, this is not advanced charting. I'm not predicting, but the S&P is not that far off of all-time highs. We're talking about a few percentage points or fraction points. Pardon?
I think Dow just made an all-time.
It might be. It's within a hair, if not there. But the Russell 2000 is probably a good 20% off an all-time high.
Yeah.
So it's so again, if you're talking about what has more room to move,
percent off an all-time.
Pardon?
Yeah, we're still probably 30% ish off.
Yes, as a firm, yes.
Yeah.
So
on our growth portfolio.
Yes.
Yeah.
On our core growth portfolio. So again, check your asset class mix, and also, if you want to be prepared, I would also say get out of cash, because you're not going to have a plan to do that, because you're not going to pick the exact right time to do it. Probably never should have been in cash to begin with. And if you've
been blessed enough to be in cash and missed some of the downs in the market over the last couple of years, then you should start nibbling back in.
Correct. You got one right, take the win, but don't wait for that perfect time to get back in, because it's not going to happen. Right. So develop a plan, whether you just want to go all in or whether you want to start legging in, which is generally easier psychologically for most people.